Hey guys, my name is Faizi and this video is going to be a short overview of ASX VAS. Before we get into it, this video is not financial advice. I'm not a financial advisor. We are speaking in a very general sense only. I just have a passion for finance and investing, same as you, so let's get into it. Now VAS stands for Vanguard Australian Shares Index ETF, and the great thing about this ETF is that it tracks the index, which is the ASX 300. So it's highly diversified, even more diversified than the ASX 200, because it holds all of the companies in ASX 200 plus an additional 100 companies that are smaller cap. Now when we say it's highly diversified, we mean that it covers over 90% of the Australian equity market. So if you buy into this, you're getting a very good picture of Australia. Now this ETF is very similar to A200, which tracks the index, which is ASX 200. And that ETF is by BetaShares. Now I've actually made a video about A200 before. There should be a link in description and there should be a pop-up on your screen as well right now. Now personally, I don't invest in VAS, but I prefer A200 instead. Now at the end of the day, whichever ETF that you buy into, you're still getting a very diversified view of Australia. VAS is just more diversified. Now the key facts about this ETF is that it's got a fund size of about 7.45 billion and it's domiciled in Australia, which is quite good. Now the fund inception is basically how long the ETF has been running for, and in this example we can see that it's been running since 8th of May 2009, which is over 2 decades, so it's very good to see. And the management fees are 0.1% per year, which are still fairly low, but they aren't the lowest of the fees that I've seen. I've definitely seen fees that are 0.04% or even 0.03% with some other ETFs, but at the end of the day, it doesn't really make much difference because they're still very low in comparison. A fee of 0.1% with this ETF means that you'll pay $10 per $10,000 invested, so it's very small, very negligible. Now if we compare these fees to A200, they charge a fee of 0.07% per year and this ETF is 0.1%, so VAS is a bit expensive, but it's very nominal. Now guys, if you are finding value so far, please leave a like and subscribe. It really helps out with the YouTube algorithm. Looking at the net asset value, currently it's about $87. Now as with nearly all ETFs, the reason why you would buy this is to buy and hold for the long term, and your investment should generally go up in value. And this ETF will give you exposure to nearly all of Australia's companies, all of the big and most of the small companies. So how has this fund performed so far? Let's have a look into it. So looking at the 1 month return, it's basically the same. Looking at say 1 year, it's quite good at about 42%. Now just keep in mind that this was when the March crash happened last year, so the returns are going to be a bit skewed for 1 year. But looking at a 5-year return, it is somewhere around 37%. And looking at the return since the fund started, since 8th of May 2009, the return has been about 72%. Now these returns are all okay, but let's look at the compounded annual growth rate of this ETF, also known as the KGR. So here I've got the KGR calculator and I'm going to start off with a 5-year compounded return. So to do that, we're going to make this graph for 5 years and we're going to look at the price 5 years ago. So in here it was $63.40. So I'm just going to type that in. And the end value, which is the today's value, is $87.08. So let's put that in. Now the years is going to be 5 years because this graph is for 5 years. So let's just put 5 years over here. And the return is somewhere around 6.55% annually. So if you invested in this ETF 5 years ago, you would have gotten a compounded annual return of about 6.5%, which definitely beats your savings account by far. But let's look into the 10-year compounded annual growth rate for this ETF. So I'm going to switch the 5 years to 10 years. We're going to leave the end value the same because that's current price. And we're going to look at the price of this ETF 10 years ago. And that would be somewhere around March 2011. So let's have a look at that. So on 18th March, the price was $59.99. So let's just put that in. And the 10-year return for this ETF is about 3.8% annually. Now with this figure, you guys can definitely see that this return isn't the best thing in the world. It isn't very amazing and it's not too exciting either. If you were to buy into this ETF at regular intervals, let's say you were to buy this ETF monthly, then you would be up quite a lot. And that's why dollar cost averaging sometimes works really, really well. Now just keep in mind that these returns are not guaranteed in any way, shape or form. Past returns do not guarantee future returns. However, we do know that the market tends to trend upwards. Now guys, if you want to get started with investing, there's links in the description where you can get started with SelfWealth or Perla. And with these affiliate links, you can get some free trades to get yourself started. Now looking at the number of holdings for this ETF, we can see that it's over 3 300, which is so much more diversified than the ASX 200. And looking at some ratios, we've got the equity yield over here, the PE ratio, the price to book ratio, ROE, and some other metrics as well. Now looking at the sector allocation, this basically shows us a snapshot of the Australian share market. Since we're quite heavily into our banking and materials sector, these two sectors make up roughly 50% of our entire market, and healthcare is the next one down at about 10%, which is nearly half of materials, which might be a bit surprising to you guys. And some other allocations that we have are in real estate, which are 6.7%, industrials, consumer staples, and so on. Now, since this ETF is obviously Australian, 97% of the ETF's holdings are based in Australia, and we've got a very small portion of 2.6% in other. Now, I tried to figure out what this was, but I wasn't able to find it out, but it's quite tiny, so it doesn't really matter in the long run. Now, looking at the holding details of this ETF, which are the actual companies that this ETF is tracking, we've got BHP at the top at about 7.5%, then followed by CBA, which is roughly around the same, then CSL, Westpac, a few of the banks, and some other material companies, and so on. And you can see that most of these first 15 holdings are based in banking and materials, because as we looked at earlier, these two sectors are the largest sectors in the Australian economy, and this was a similar theme in the A200 ETF as well. Now down here, you can click this link, which will take you to this little pop-up. Then down here, there's a link that says export to CSV. Once you click on this, you can see all of the holdings that this ETF holds. And it's basically a spreadsheet that you can use to analyze and have a look at all the companies. And some companies have a very little allocation as well, at like less than 0.01%, which is just crazy small. Now, having a look at the distribution frequency for this ETF, the distributions are paid quarterly, which means that you will get a quarterly dividend. Now, this is quite good for us Australians because normally we're used to getting dividends every 6 months, but with this ETF, you will get paid 4 times a year, which is a little bonus. Now, when it comes to ETFs, you might want to diversify in the Australian market, but there is one lucrative market that you can't ignore, and that's Asia. This video compares the top 4 Asian ETFs that you might want to diversify into because Asia is set to grow quite rapidly in the next few years. And this video talks about A200, which is the ETF that we discussed in this video. Thanks for watching, guys. Please like and subscribe, and I'll see you in the next one. Bye now. Having a look at the distributions. Now, having a look at this